What's the biggest financial mistake people make after divorce? It's not what you think. Many assume the hardest part is splitting assets, but the real danger lies in what comes next. Hidden debts, tax surprises, and lifestyle changes that drain your savings. Divorce isn't just emotional, it's a financial minefield. If you don't plan carefully, you could end up struggling for years. But don't worry, I've got you covered. In this video, we'll break down the 10 biggest financial mistakes to avoid and how to rebuild your future the right way. So, without any further delay, let's get started. Number 1. Not understanding your marital finances. One of the biggest financial mistakes after divorce is not fully understanding your marital finances. Many people leave financial matters to their spouse, only to realize during divorce that they have no clear idea of their assets, debts, or expenses. This lack of awareness can lead to an unfair settlement where you might overlook hidden savings, investments, or even shared debts. Without a full financial picture, you could end up with less than you deserve or be responsible for debts you never agreed to. To avoid this, gather all financial documents, including bank statements, property deeds, loan agreements, and retirement accounts. Consulting a financial expert can also help ensure you don't miss anything critical in the process. Number 2. Underestimating post-divorce living expenses. After divorce, many people assume their cost of living will go down, but that's rarely the case. In fact, maintaining two separate households can be much more expensive than sharing one. Expenses such as rent, utilities, insurance, transportation, and childcare can quickly add up. If you don't plan ahead, you might find yourself struggling to make ends meet. Additionally, there may be unexpected costs like legal fees or moving expenses that you didn't anticipate. To prevent financial hardship, create a realistic budget before finalizing your divorce. Account for all necessary expenses, and make sure you negotiate a fair settlement that allows you to maintain a stable lifestyle without unnecessary financial stress. Number 3. Overlooking tax implications. Divorce settlements aren't just about dividing assets, they also come with tax consequences. If you don't consider these, you could end up owing more than expected. For example, selling a home or cashing out retirement accounts can lead to significant tax bills. Spousal support is also taxed differently than child support, and making the wrong financial moves could mean paying more in taxes than necessary. Many people also forget that different assets have different tax treatments, meaning that $50,000 in a retirement account is not the same as $50,000 in cash. To avoid costly mistakes, work with a tax professional who can help you understand the implications of asset division and ensure you don't face unnecessary financial burdens. Number 4. Clinging to the family home without financial consideration. The family home holds sentimental value, especially when children are involved, but keeping it without considering the financial impact can be a mistake. Many people fight to keep the house without realizing they can't afford mortgage payments, maintenance, property taxes, or repairs on a single income. This can lead to financial strain or even foreclosure. While it might feel emotionally important to keep the home, it's crucial to evaluate whether it's a smart financial decision. In some cases, selling the property and splitting the proceeds is the best option for both parties. If you do decide to keep it, make sure you can comfortably afford it without compromising your long-term financial security. Number 5. Failing to update estate planning documents. Divorce doesn't just change your relationship status, it also affects your legal and financial documents. Many people forget to update their estate plans, which means their ex-spouse could still have control over their assets or inherit their wealth. Wills, trusts, power of attorney, and beneficiary designations on life insurance policies or retirement accounts need to be updated immediately after a divorce. Failing to do so could result in unintended consequences, like your ex receiving benefits you intended for your children or family. Take the time to review all legal documents and make the necessary changes to reflect your new life circumstances. It's a simple step, that can prevent major problems down the road. Number 6. Ignoring retirement accounts. Retirement savings are often among the most valuable assets in a marriage, yet they're frequently overlooked during divorce settlements. Many assume their retirement funds are untouchable, but in reality, they are considered marital property and subject to division. Failing to properly account for them can mean missing out on a substantial portion of your financial future. Additionally, withdrawing funds without a proper court order, like a qualified domestic relations order or QDRO, can result in taxes and penalties. To protect your retirement, ensure these accounts are valued and divided correctly. Consulting a financial advisor can help you understand your options and make sure you're not giving up what's rightfully yours. Number 7. Overlooking hidden assets or debts. Sometimes, one spouse may try to hide assets or debts to manipulate the divorce settlement. This could include undisclosed bank accounts, secret investments, or even credit card debt accumulated without the other spouse's knowledge. If you're not diligent, you could end up receiving less than your fair share or being stuck with unexpected financial obligations. It's crucial to conduct a thorough review of all financial records to ensure full transparency. If you suspect hidden assets or liabilities, hiring a forensic accountant can help uncover any discrepancies. Taking this step ensures that the division of property is fair and that you're not left with financial surprises after the divorce is finalized. Number 8. Neglecting to separate joint accounts. Keeping joint accounts open after a divorce can create financial complications. If both names remain on a credit card, bank account, or loan, you could be held responsible for your ex-spouse's spending or debts. Some people assume their ex will be responsible for payments, but if they miss a payment, it could damage your credit score. The longer these accounts stay open, the greater the risk. To protect yourself, close or separate all joint accounts as soon as possible. Open new accounts in your name and ensure all financial obligations are properly assigned in the divorce settlement. This step will give you full control over your financial future and prevent any post-divorce surprises. Number 9. Making emotional financial decisions. Divorce is emotionally charged, and when emotions drive financial decisions, mistakes happen. Some people fight for assets purely out of spite, without considering their long-term financial impact. Others make rushed decisions, like selling property too quickly or agreeing to unfavorable terms just to end the process. Emotional decision-making can lead to financial hardship later on. The key is to approach financial matters logically, not emotionally. Take time to assess each financial choice carefully and seek advice from professionals if needed. By keeping emotions out of financial decisions, you can make choices that support your long-term well-being rather than causing regret down the road. Number 10. Failing to seek professional financial advice. Divorce is one of the most complex financial events in a person's life, yet many people try to handle it alone. Without professional guidance, costly mistakes are inevitable. Laws vary by state or country, and financial implications can be complicated. A financial planner, tax advisor, or divorce attorney can help ensure you're making informed decisions and protecting your future. They can identify tax pitfalls, evaluate assets fairly, and help you build a post-divorce financial plan. Investing in professional advice might seem like an added expense, but it can save you thousands in the long run. Don't navigate divorce blindly. Get the right guidance to secure your financial stability and peace of mind. Divorce is tough, but avoiding these financial mistakes can set you up for a stronger future. By planning wisely, seeking professional advice, and making informed choices, you can regain control of your finances. If this video helped you, don't forget to like, share, and subscribe to Resilient Wealth for more financial tips and life advice. Thanks for watching. Until next time, stay strong, stay informed, and take control of your new beginning.